When most people hear land investing, they picture flipping raw dirt or speculating on a future development. But John Jasniak has taken a very different approach. In this episode of the Passive Income Playbook on the Best Ever CRE Show, I'm joined by John Jasniak, founder of Jazzland and a leading voice in the direct-to-seller land space. Over the past few years, John has bought and sold thousands of acres and built a note portfolio with over 150 plus performing land loans. I think it's over $10 million at this point. And so he knows his way around this space. And in this episode, we're breaking down the different ways that you can invest in land and which strategies actually cash flow. Why John chose seller finance notes instead of maybe flips or entitlements or any other niche. The pros and cons of land versus other real estate asset classes. And for the LPs listening, we're also going to dig into what you should understand before putting your money into land deals. And with that, I'd like to welcome John.
Hey, man. I love it. Thanks so much for the kind words and the intro. And thank you so much for having me.
Yeah, I'm excited to get in here. But one of the things you mentioned right before we got on the show was that you own a town in Texas. It's a 30-acre area. You've got a motel, a cafe, an RV park. Like, tell us about this town.
Yeah, well, I've been blessed enough to make some money in the land space and somehow thought it would be a good idea to purchase an unincorporated town called Cornudas, Texas, out near El Paso. And yeah, everything you described, we host cool events. We have a cafe out there, short-term rentals, and it's been fun, but it's also been a giant pain in the butt. It's a lot of work and it's a lot of money, but it's been fun. It's definitely got me some attention on the social media space, that's for sure.
Yeah, I imagine why do something like that? Like, why venture out of your own? You're either like a deal guy and you just put deals together, or a publicity stunt in some way.
Well, yeah, when people ask me why I did it, if I'm being truthful, it was more of a publicity stunt because I'm like, hey, what better way to become the known go-to person in the land space than to own your own town? So yeah, back in 2023, I bought it and we're well over $1 million into it now. And I guess still trying to figure out how to really make money out there. We're like break even right now, but yeah, $1 million, we got a long way to go to get that money back.
Yeah. And so like the idea is you're going to try to attract people to come there, and you need to orient around some sort of space, bachelor parties or wedding events or something like that.
Yeah, all of that. And then our main draw is El Paso. We're like 50 miles from El Paso. So it's a whole different culture too than I'm used to. I'm a white boy from Detroit, Michigan, and that is very, much Latino vibes. And so, trying to learn a new culture, deliver them what they want, do interesting stuff, get people out to the property. It's been fun, but a lot of work, that's for sure.
Yeah. No, I appreciate you sharing. Always, fun to talk about. So what I would love to get into this episode today is to educate us around land investing. You do a very particular type of land investing, and you are also going to school us on all the ways that you could invest in land so that we can understand how to be better investors in this space and see if this is interesting for us. So can you start out by giving us, first, maybe give us a little bit of street cred? Like I mentioned a little bit about your fund and how many performing loans you have in it. But give us a big background with stats and figures that we should know about you before you tell us everything we need to know about land.
Sure. So been doing this since 2017, so 8+ years now. Really, my expertise nowadays is like subdividing land outside of city limits and doing, hundreds of acres at a time, $1 million+ multi-million-dollar deals. Done over 30 subdivisions now, gross sales somewhere north of 30 million, probably 10,000 plus acres. Of course, have raised millions of dollars, have used millions of dollars of my own. We just wrapped up with one project out near Midland, Texas, out in West Texas. It was a 76 lot development. We bought it for 2.1 million, put about 400,000 into it. So we're 2.5 into it. 76 lots, sold them all in 2 months. 80% of them seller financed, and the total exit on that will be like 5.7-ish. within like 6 months, I'll exit and be, it'll be completely wrapped up, selling a bunch of papers. So like that's a pretty traditional, typical deal nowadays is like, buy for 1 or 2 million, light improvements, a light development, and sell it for, 2x is kind of my ballpark number. But of course, I didn't start there. I started with, what you described, like your little flips, like I'll buy a little lot and sell it for double or triple.
I love that. Tell it. Yeah. Give us a little bit of that story.
Yeah. So, I mean, I went to school as a petroleum engineer, went to Texas Tech, graduated in 2015, and quickly hit the corporate world and figured out it was not for me. So I was listening to a podcast like this. Some dude comes on and says, "Hey, you should look at land flipping. You can make all this passive income. You can, buy a lot for 5,000, owner finance it off for 15 or 20,000 and get, a few $100 a month." And so bought a couple courses and hit the ground running. It would have been 2016 while I was working the W-2, and quickly fell in love with the land space. I think the first year I did close to 100 deals. First deal being just a little flip out in Hudspeth County near Cornudas, actually, where I bought 53 acres for $8,500. It was already kind of broken out into 5 little lots, and I sold each lot. Made, grossed about 18K, so doubled my money, give or take. And that was kind of the first little deal. And, I bought dozens, if not hundreds of those since. And then shortly thereafter, figured out, I could do one deal that's big, multi-6 or multi-7 figure, or I could mess around with all these little small deals, which, it's a valid business model. There's a lot of flippers nowadays doing, 100, 200 deals a year, making a few $1,000s a pop on land. But that's just not my forte. That's not my cup of tea. I don't like all that work and headache and management.
And so you've decided to go upstream.
Yeah. Do bigger and just spend time and energy hyper focused on one deal. Biggest bang for your buck.
Yeah, I love it. Okay, cool. So that sets the stage here of how we got here. So I'm an investor here, and land is something you hear about often. And
yeah,
there I've heard many things like he who controls the dirt controls the deal. And it's often one of the best places to start when you're thinking about any big project. What are all the different ways that you as an investor can play in the land space?
Man, so many different ways, whether, like we just talked about doing small little flips, they call them desert squares, where you're literally buying land in the middle of nowhere, pennies on the dollar, and turn around flipping it for more, all the way to, wholesaling in the land space is pretty big. You got your traditional kind of what people think of when I tell them what I do, they immediately think of like, oh, you're in the city, you're entitling, you're working with developers, doing these crazy plats and engineering. That's one business model, getting crazy engineering, rezoning, entitling. That's like big boy, high risk, high scale. And then there's everything in between. Like I said, there's wholesaling, there's assigning, there's getting land under contract, working with developers for storage, multifamily, recreation. There's a huge recreational component to land, just buying wooded or, recreational pieces out in the middle of nowhere for people to hunt or play around on. And, affordable housing is big nowadays. So creating lots for mobile home, land home packages, barn dominiums, RV parks, mobile home parks. Like, to your point, if you find a good deal on a good piece of land, I can almost guarantee you can do multiple different things with it. You could develop it like I do, sell it to Joe Schmo. You could work with developers. You could work with storage guys. It like, to your point, who controls the dirt kind of controls the deal. I mean, that's very much true as long as it's the right piece of dirt, I would say, and, the right space with the right area and the right zoning, all the different criteria, which is where it gets complicated.
What do you think separates land from any other asset class, like a multifamily apartment building or a self-storage facility or,
yeah, Well, multiple different things. From a high level, land, I would say, is considered a niche. I mean, just not many people know about it. Not many people are interested in it. And to your point, what separates it largely because land is not as bankable, in my opinion. You have no structure. Banks tend to view it as, oh, it doesn't cash flow, which I mean, I guess is true to a certain extent because, I could say I have cash flow on all these owner finance notes I have, but those notes are going to go away. People are going to pay it off. Cash flow is going to disappear. So I guess you would say it's almost like a different type of cash flow. Not a highly bankable asset. I mean, of course, land is bankable. You can work with banks, but they're going to view that a lot differently than an actual structure or improvement on the property. And you can't depreciate land. So there's a big tax component to it too. A lot of investors like yourself, I'm sure, are very interested in tax components when you're looking at a real estate deal or trying to park your money. You can't depreciate land. So you can depreciate, do bonus depreciation, cost segs, et cetera, all that good stuff on multifamily storage, all those different components, but you can't do it on land. So I think that keeps a lot of investors and they shy away because of that.
So as an investor, and obviously the answer is definitely, I imagine, different across any different strategy that you do with the land, but is the primary growth just to grow your equity?
So it's a great question. And I always laugh. I think you kind of hinted on two different things in there. First, I would say talking about the strategy. I think I've kind of pinpointed, at least it's my favorite strategy. I think it's the best strategy in the land space, is operating outside of city limits, but still close enough to the city where you're close to the amenities, but you don't have the heavy zoning, entitlements, engineering requirements. Like I step just outside of city limits or as close to it as possible. And that's where I target my land because it's so much easier. Like I'm just dealing with counties in a lot of cases. I don't have to do rezoning. I don't have to do crazy engineering. I probably have to do some proof of water, some light roadway construction, but that's it. I can paper up these lots and sell it off to Joe Schmo. So that's a huge component to it as far as the strategy goes. The other highly scalable strategy that I like is like the entitlement game, but it's higher risk. Like you're stepping inside of city limits, you're working with local governments, all that good stuff. It's a lot more risk, a lot higher dollar, but it's more scalable.
So like if we as LP investors are looking at different deals in the land space, I'm imagining that are they all geared towards just doubling your capital as quickly as possible, and you would maybe choose investing in land um, as a way to grow your wealth instead of buying a multifamily apartment building because
Yeah.
there's less risk, or like walk us through that.
So that's the whole thing that I think goes over a lot of people's heads, in my opinion. This is kind of what I tell people is like, if you want the highest returns in real estate and to grow a bunch of wealth quickly, I think land is your best bet. If you want a tax strategy, a place that's tax advantageous to park your money or to invest in, land is not your best bet at all. But kind of what my philosophy is, make as much money in the land side. I'm obviously a very active investor. You can invest in it passively as well. The returns are a lot higher. When I make a bunch of money, find a different asset class to invest in, whether it's with you or someone else in a fund as an LP or GP, whatever it is. Go invest in multifamily, get great tax advantages with all this money that you made in land. Like, I don't think your returns are going to come anywhere close to the land space in multifamily storage, RV parks, whatever it is. But go make a bunch of money in land. That's kind of what I'm trying to do. And then park that somewhere else when you have a tax problem. It's basically my mindset.
So tell us like what is common or the range that you can expect maybe as an LP investing in the land space.
Are we talking ROI or annualized IRR? Like, I think
give us it all.
Okay, so kind of what I see in the land space, there's really two different things you can do. You come in as a debt investor, and I would say anywhere from 12 to 25% as a debt investor, just straight cash flow amortized debt is pretty common in the land space. Probably 18 to 25 is more so. Like the interest rates that I give my private guys are quite high. Now, from like an ROI or an IRR perspective, your IRR, your actual yield on investing in land it's hard to say what's common because obviously varies deal to deal, but I would certainly put it at 30 to 40% minimum. Like, as high as 50 to 100%. It really just depends on the situation. Depends how good the operator is and how quickly the operator can move. But what I see time and time again is the yields to the investor, if you're an LP or, coming on as some sort of equity partner, is just way higher than your multifamily or storage or, these other real estate components. But again, no tax advantage to it.
Well, why do you think is this asset class not more explored or invested in? I mean, we've kind of been hitting on the tax issue. Are there other reasons here?
I think it's also the banking component and the institutional money are not interested in land just because, if I'm being honest, it is not as scalable as multifamily or, some of these commercial asset classes. To do $100 million land deal is pretty difficult. Like you're talking like full on subdivision, curb and gutter, like working with municipalities, governments, getting things approved to go buy $100 million apartment complex. Like those deals happen every single day. So the scalability, the lack of institutional interest, the lack of bankability, I think those are the main components. Throw in the tax component there. I think that's why a lot of the big boys and then, it doesn't get the attention. If the bigger guys aren't doing it, it's not really talked about. It's like, it's more of a niche product.
Yeah, what are common misconceptions that investors have about land that you often debunk?
That it doesn't cash flow, which I guess we talked about. It's true to a sense, but owner financing is huge in the land space. So there is a cash flow component. That it's illiquid, very much not true. This land, especially if it's in a desirable location, sells very quickly. And then there's a huge misnomer, kind of what I touched on when you talk about like subdividing and development, whatever. People immediately think that like, oh, you're working with D.R. Horton, or oh, you're doing, some crazy rezoning or engineering and building detention ponds and blah blah blah. Like all this, that's really not the case. And although those land deals do exist, again, that's more like the big boy development, like you're inside city limits or, working with local governments and actually building like, you know, half or 10th acre lots that DR Horton's building 3x2s. Like those developments are out there, but that's a completely different asset class than kind of what we're talking about.
You've mentioned a few times already this idea of working within city limits and outside of city limits. And
Yeah,
to me, it feels like it's starting to draw a big line here of
sure.
what is the risk. Can you talk to us through about the risks that happen when you're talking about in
Yeah.
or out of city limit?
Yeah. So if you're inside of city limits, immediately the big thing that comes into play is zoning. So you're dealing with a piece of land. Now you have a restricted use. It might be zone commercial. It might be zone, A2, A3, whatever the different zoning criteria are. And that immediately limits what you can do with the land. Okay. Now, if you want to do something different with the land, which is often the case, now you're immediately into rezoning. That's a huge component. Costs a lot of time, money. And then you're dealing with the engineering component. When you're inside the city limits, you're immediately hit with a lot stiffer regulations for road, water, sewer, all those different things. You're talking, and this is why it's a higher risk game, is because not only are you going to have to convince or get a seller to give you that due diligence period of months, if not, a year at least of due diligence to do all these different things, try and get it rezoned, etc. So you're coming more out of pocket for the option. You immediately have a lot higher engineering and consulting fees. And then the risk is high because is the local government going to rezone you, or is the water line have enough capacity to do 1,000 lot development? There's so many different things that come into play. So big dollars, hundreds of millions, but also big dollars up front with more risk. And this is why you often see, developers passing on deals and they're stuck in due diligence. And that's why the wholesale game, I think, is so big in city limits, because it's a very difficult product and difficult thing to manage. People would rather just wholesale it to a big time developer who can get it done with the experience.
Wow. Are there key? How often do your plans not get rezoned? I mean, that sounds like a huge risk. And how do these big companies mitigate it?
Quite often. I mean, quite often it doesn't get rezoned, or you're in due diligence and you find out that the water line infrastructure needs $5 million just to run a 12-inch line to your property, as opposed to, the 2-inch line that's along the property. How do they mitigate the risk? They have a bankroll and a capital outlay up front that they are, willing to expend to research a project, and they write it off basically as a sunk cost up front, where, hey, it's going to cost $200,000 in engineering, but we might make $100 million on the project. Like to them, that's pennies. But to me, I mean, or to the average person, I mean, could I stroke a $200,000 check? Sure. But do I want to be doing that left and right and rolling the dice on, less than a 50-50 chance that this thing's going to get to where I need it to be? Probably not. Maybe at one stage in my career. But, probably not right now.
Yeah. Moving more macro, how is land impacted by different economic cycles?
Well, really two different components of land. The financing side, which has not been impacted much at all on these high interest rate and this, economic cycle that we're in. If anything, I would say that it may have helped the owner financing space because people would rather owner finance than to try to go to the bank, pay high interest, get approved on, loans and stuff that are tighter nowadays. And they're not giving out money left and right like they used to. So the owner financing space has probably actually gained a little bit of strength. Now, the cash side of the equation, if you're trying to sell land for cash or you're trying to do these big dollar deals of, multi 6-figure pieces of land near the city, that has all but ground to a halt. It started to pick up. We've seen it pick up a little bit here in the last 2 or 3 months. We've had some more cash sales come in, but the earlier part of this year, that just absolutely ground to a halt. We were not selling any land for cash, and no one was getting lending. No one was getting bank loans.
Wow. So there's a good time and a bad time to be investing. Is I think where
Always.
I'm trying to drive this. Tell us what do you see? How have the last 5 years fared, and how do you see it moving forward? Right here, macro for
Yeah,
land.
from a macro perspective, I mean, the last 5 years have been fantastic. During COVID, there was a ton of opportunity on the buy side. I mean, deals left and right. Money was easy. They're giving it out left and right. And, we talked about that has slowed down a little bit. The biggest thing that I'm seeing right now, and we know this from real estate in general, I think there was some report that came out from Redfin or wherever like last week that said there was like 500,000 more home sellers right now than buyers or something crazy. And so in the land side, from these sellers, I'm sort of seeing the same thing. Like when we're trying to identify a prospect for a subdivision, these sellers are sky high. They still haven't come off their price. Their land's been listed on market for a year. They're asking 30 to 50% more than I think the land's worth, and the land's not moving and they're not coming off their price. And so, it's become a little bit more challenging for folks in the land space, I think, to find deals to then, either improve or develop and then sell. But if you can find a deal and you could develop it and get done what you need done, I mean, the owner financing component of the sales is still super strong.
All right, I like it. I would love to dive into your strategy a little bit more. So you helped clarify quite a bit about all the different ways that you could play in the space, maybe the different risks. But now diving into you do seller financing,
Yes.
or walk us through what does that mean?
So I do financing on both sides of the deal. Actually, I love the seller financing component when I'm buying land. If I can get the seller to carry the note, that's hard to find, especially nowadays, because like we just talked about, they want top dollar. They want to be cashed out. They don't want to do seller financing, but you can still find it. And then on the sales side, huge seller financing guy. Like I love carrying good quality paper with, 10% down. Doesn't have to be a high down payment, 5 to 10% down. If you can get 10% or more down, even better, of just high quality land near a decent sized metropolis, whether it's a huge city like Houston or a smaller city like Midland, Texas, and, originating good quality notes at 50 to 100,000 each, monthly payments of give or take $1,000. And yeah, I mean, I love it. It's easy and buyers love it because they don't have to go to a bank.
How did you get into doing that?
Back to the glory days of 2016 on that first podcast where if you're in the land space or have heard any of the quote unquote land gurus talk about land, it's always very much pitched as a passive income model, very little work, sit back on your butt and just collect monthly payments. Now for those of us who are actually doing it, we know that's not true. It's actually billed to as a dream that is not quite possible because this is, definitely a passive business model, but very much so from the beginning where, all the land people pitch it as, hey, it's passive income, originate these owner finance notes and collect the monthly payment. But they don't talk about what happens if someone stops paying, what happens if the land doesn't sell, what happens if something goes wrong. That's never talked about.
Wow. Yeah, I imagine. Okay, so tell us, like, so first you started flipping land, doubling your money, and then at one point you started loaning or giving this financing out, like,
Mhm.
did you have mentors that kind of taught you how to price the notes? Is it very relationship driven? What have you learned along your journey of managing these notes?
Yeah, so multiple mentors and different people along the way. The biggest thing in the owner finance space is you got to be able to work a loan calculator, and you got to be able to underwrite. You got to, know how much you're getting monthly in both principal and interest, the face value of the note, how much you can sell those notes for. I'm a big proponent of selling my owner finance notes. We sell millions of notes every single year to raise capital just to keep the business moving. And you got to be able to work a loan calculator, and it is a game of networking, getting to know the private money guys, the investors, the people who are buying the notes, what are notes trading for. Good resources, paperstack.com. That website's like a note trading platform, and I've sold many notes on paperstack. And so, yeah, I mean, I sold my first note in 2018 to an investor mentor of mine, Mike, in Texas, and I've been selling notes, originating notes ever since then, 2017, 2018.
And I'm imagining that your process is very different today than
Yes.
how you started when you've gotten into this. Walk us through your first couple, what you've been learning.
So the biggest thing that I would go back and change is the down payment that I've collected. Back in the day, I was very much a low down payment guy. Like I would, buy a 10-acre lot for 5 grand and sell it for 15 grand. And I would do like 400 down, 400 a month for, 60 months or something. And so the down payment was like 1% or 2%. And, most investors, most note buyers, most people who analyze those notes don't like that. And obviously I don't like it either. I want to get my capital back as quick as possible. But my mindset was always very much, man, I could sell my land super quick. Let's do low down payments and sell it within a week, which, I guess is good for a beginner, especially you get the cash flow going. But if you ever want to sell that note or collateralize that note or do something with it, I mean, that's one of the first things that anyone's going to look at is your down payment. So that's very much changed over the years. Now we like to get 10% if we can, or as close to it. So
That's a good one. I'm imagining that. When did the light switch for you about deciding to collateralize and then resell? And like walk us through like in super simple terms, like I'm five.
sure.
Like so you're basically setting up these loans and then selling them again. Talk us through all that.
Yeah, and real quick on the down payment side, it's super important too to get your down payment solid, because otherwise the buyer doesn't have any skin in the game. Like the default rate on low down payment land notes is high, like probably over 20%. Because if someone gives you $400 a month for a recreational piece of land, they gave you $400 down. Like as soon as they're done using it, they've hunted on it a couple times. Like, I'm just going to stop paying on it. So super important. Now, let's just go through like the very first deal that I did, like where I sold the note real quick. It was a subdivision, 534 acres, bought it for $40,000. It was like $78 per acre out in Hudspeth County, Texas.
And this was
And
your first one,
first subdivision. Yep.
and you
Yep.
decided to
And
go for it because
I was crapping my pants at the time. I decided to go for it because it was stupid cheap. And I was looking at all the other land in the area was selling for $400 or $500 an acre. And this dude calls me up, just came out of bankruptcy. He's like, I got this 534 acres to sell. I'll do 40 grand. And I was engineering at the time. I'm like, I don't got 40 grand in my bank account. So I ended up borrowing 35 G's from my dad and bought the piece of land and was crapping my pants the whole time. Typical fears that the beginner land investor has. Will it sell? Who's going to buy this? All those different things. But long story short, one guy came in and bought 450 of the 534 acres, paid me $3,000 down, again, the low down payment, and 4,500 a month for 60 months, just on 450 of the 534. And keep in mind, I paid 40 grand for this whole thing. So like, after 8 months of payments or whatever, I was going to be in the black. And so I ended up collecting on that note. We set up, promissory note, deed of trust, warranty deed with vendor's lien. Texas is a deed of trust state, recorded all at the county. It goes into my little note management software I have. Collecting payments from this guy, just auto pay every single month. Boom, boom, boom. 4,500's coming in. It was like 17 or 18 months later in late 2018. That's when I met a mentor investor friend of mine, Mike, in Texas. He's like, hey, I'm trying to buy notes. I like to buy land notes. Do you have any for sale? And I'd never sold any at the time. So we met up for lunch and he brought his little notebook and loan calculator and shows up and writes me an offer on this 4,500 a month note. And there was, I think, probably 42 months left on the 60-month note. And Mike got a great deal. He got a 30% yield on that note, which is stupid high. And he wrote me a check for 120,000 bucks. And so that's kind of where the light bulb kicked on. I was like, I collected 18 months at 4,500. I already made money on this deal. Plus I got another 120 to go do more deals. And so that's kind of where my development career kind of took off, because then I started doing more deals like that. Then it started getting bigger and bigger and bigger, and just holding these notes and slowly selling them along the way.
Wow. That's a cool story.
And that land is like 2 miles from Cornutus, by the way, the town I own nowadays. I go back out there all the time and I show people, hey, this is my first subdivision. It's kind of crazy.
So what are things in your process that you make sure that you structure? Like, do you go in and only touch, like less than 50 acres, or does it really just depend on the opportunity that comes your way? And then you're trying to like figure out what are the exit strategies and...
Yeah. Well, there's several different things that go into it. As a beginner and back in the day, and I will still tell any beginner this, like I wouldn't really criteria based on the land is too cheap or too expensive or, 50 acres or 30 acres or 100 acres. Like today, I wouldn't do that Hudspeth County 534 acre subdivision again, just because it's too small. Like I'm not really trying to mess around with buy land for 100 an acre and sell it for 500 an acre. I'd rather be buying it for 5,000 an acre and selling it for 10 or 12,000 an acre. So my criteria largely involves regulations, actually, finding the counties and the areas where there's good resources and good regulations. I won't really criteria or break it down on acres. Like if I could find a 10-acre lot that I could subdivide and double or triple my money, like, yeah, I'll look at it. Nowadays, it's more of a time issue for me. Like I got a small team. I only have so much time. So am I going to buy a 10-acre lot for 100,000 and subdivide it and sell it for 200? Probably not. Am I going to buy a piece of land for $1 million and subdivide it and sell it for 2 or 2.5? Like, yeah, that's probably more the wheelhouse nowadays. It's like probably minimum 7-figure. But for the average beginner, like I wouldn't be criteria breaking down on like price or acres or anything like that.
Yeah, there are KPIs or success metrics you track in these deals?
Yeah, absolutely. The IRR, the annualized rate of return, has to hit a minimum 100% on the underwriting. If it doesn't, then I won't touch it. And kind of paired with that, I like to be in and completely out of the deal after selling the notes, taking a discount, or selling cash deals at a minimum of a 2x. So like those are the two underwriting bare minimum metrics that I need to hit: the 2x in and out of the deal paired with 100% IRR. Nowadays, I only touch Texas land. And nowadays, I really want to be able to sell all of the land within 6 months. So like, I don't want to touch something that's like rec land out in the middle of nowhere. I want to touch, stuff that's kind of near or in the path of development, but still kind of outside of city limits, somewhere close that I know it's going to sell with reasonable speed.
And so when do you decide to take on LP capital or do it with your own money?
Man, that is a fantastic question. And honestly, probably one of my other biggest mistakes, along with the low down payments, is I wish I had started using other people's money sooner. A huge mistake of mine. I pretty much took all my engineering capital and just plowed this into my business myself. And I slowly started raising money from friends and family. Then I met the private investors. Now I have a couple of equity investors. I do have my own fund that's set up that we're probably doing our first deal in here in the next couple months. But like, I would start taking other people's money ASAP. Like if you're a beginner doing your first land deal, I'd rather use none of my own capital, give it up to some LP or equity partner, give them 70 or 80% of the profit and only take 20 or 30%, but not use any of my own money. So like I would say ASAP.
Yeah. But this is from the LP point of view. We're investors trying to invest in these types of land deals. When does it? What should we be looking for? Or when does it make sense in your world to raise money from LPs? Yeah.
For me personally, yesterday, I think again, raising money and utilizing other people's capital, even as LPs, I'm constant. I mean, it should be a constant thing for any real estate investor, in my opinion, is always networking, always meeting partners. That's something that most people don't do in the real estate space. They think they're going to go out and find a deal and make money, but they don't realize that raising capital and having partners and that side of it is so massive. That's something that you should be setting up and working on constantly.
Let me change gears here. So I would love to maybe understand. So you have these 150 performing loans, right? In this fund where you have $10 million, and investors are invested in that fund.
They're not. I own that 100% free and clear. But to your point, I am looking to take on investors and hypothecate those notes. Actually, huge business strategy, in my opinion. If you own notes, don't sell them, just lend against them with investors' money.
Got it. Okay, so we can come, and that's a way that you. How do people engage with you today?
Social
How
media.
do investors like? How do people? I mean, you've mentioned that you have a couple equity investors and a couple different people that have lent you money. How do you structure those deals, right? So we're here listening as an LP. We're trying to understand. Okay, what are typical deals that we could find if we go find a land investor?
I'm happy to talk about it from like an LP perspective.
Yeah.
If I were in your shoes, what I would be looking for, you really have two routes, in my opinion, to invest in land. You can invest in either a fund or outside of a fund and actually invest in a performing land note. So my note portfolio and note that I have already generated or someone else has, you're either buying it or investing in a fund at anywhere from 12 to 20% annualized rate of return, monthly payments. That is super low risk, especially if you've done some due diligence, you're familiar with the collateral, the land that the actual note is originated on looks good. Super low risk. It's already performing. Hopefully as a solid down payment this season, you're going to get your monthly payment. No problem. If the borrower stops paying, that note's going to be resold. You're probably going to get a little bit of a yield bump, if I'm being honest, because when someone defaults in mine, I'm selling it for more, or I'm originating the same term note, but I've already, kept their payments. So I'm originating a bigger note. So that's avenue number one, super low risk, can be done easily. There's funds out there, perhaps my own, that you would like to invest in. Avenue number two, investing as an LP in the actual development upfront. Your risk is higher because, perhaps something could go wrong with that development. Perhaps the land doesn't sell in a timely manner. Perhaps, you can't run the water line the way you thought and something happens. Risk is higher, but return is greater. You'd be looking at probably 30% plus returns all the way up to, I guess it just depends, 50 to 100% annualized rate of return. Risk is higher, but you're in the ground floor level right up front. A lot of operators like myself would be happy to actually teach you the process as you go along, how this subdivision actually came into place, what's going on with the water, what sort of road did we build? You want to come out and do a site tour? Like I do that stuff all the time. So that's really your two main avenues, I think, in the land space as an LP. One's low risk, one's a little bit higher risk with greater return.
Got it. So it's pretty much the same. You're either investing for debt, like a consistent payment, or
Yep.
equity. You're getting higher upside, but you're taking a lot more risk.
Yeah, exactly.
Maybe talk me through, are there legal thing, like what happens when the borrower stops paying, and how often does that happen?
Yeah, let's talk about that then. I want to talk about kind of how I structured, if you're cool with that. Like, I think there's actually big opportunity for LPs and investors there. But as far as like what happens from a legal sense, it really depends on the states. Texas is very favorable. Texas is super easy. We have what's called a non-judicial foreclosure process. So when the documents get recorded at the county, the deed of trust and the warranty deed, borrower stops paying, we send them a couple notices. We just sent out notices today, like literally right before the show. 4 notices went out. 4 people were in default. We accelerated their loan. They got a notice. 20 days went by. They didn't pay. So now we accelerated their loan. Now it'll be another 23 days or whatever it is to the first Tuesday in October when we're recording this. First Tuesday in October rolls around. Literally, we're going to have to show up to the courthouse steps in Texas, read off a script, and we will claim the land back. Basically, we're going to put in a bid as the creditor for the remaining principal amount owed on the note. No one ever shows up to these things and bids. So we're going to be bidding on our own land. We're going to win as the creditor. Then we're going to file just a simple little trustee's deed, and the land's going to come back into Jazz Land's name. And then we're going to resell it. So the whole process from default to taking the land back is anywhere from 41 to 62 days, depending on timing and the calendar. And then it's just how quick can you get that land resold?
Wow. And then, when you think about reselling the land, I imagine that is one of the biggest risks. It's like, how do you know how much demand there is going to be for a piece of land? I imagine that goes into your due diligence process of figuring out which notes to take on.
Yeah, exactly. And so from like an LP or an investor's perspective, even my perspective, I would not be worried about that because we kind of already de-risked that up front in the sense that we bought this project, we originated these loans, we're very confident in, location, the land demand, et cetera. So if someone stops paying us, as long as they're not squatting on the property, which I've only had one time in 7 years now, we're just going to resell it for the same, if not more.
It makes sense. It makes a lot of sense. Okay, overall, very helpful to get this just concept of the different types of land investing, how you play, how we can play. Are there any kind of, maybe subtle cues or red flags or things in the land space that you think are riskier or riskier or more warning signs?
Well, from an investor LP perspective, I think it's super massively important to trust your operator, the person you're investing in, because, from the people I coach and talk to, I cannot tell you how many times these other quote unquote developers, people trying to do it, just do not know the regulations, do not know the rules. They might go out and buy a piece of land and not know that they need to do a water study. They might go out and buy it and think they can make 5-acre lots when really they can only make 10-acre lots. And I was like, what do you do as the investor or, person who's given them money? So the trust there and the relationship is huge. Probably good, just like, any asset class you're investing in, you probably want kind of a base knowledge of what's going on and understanding. But like, let's be honest, like you invest in me and my project, that you're not going to know that there's a 2-acre minimum for on-site septic. You're not going to know that the groundwater is 270 foot deep and does 30 gallons per minute. Like, you're trusting me to go figure that out and put that all together and then get it submitted for approval. So if you don't have that trust, and with a reputable known operator, I guess just like any other asset class, I probably wouldn't be investing with that person.
So I think the examples you pulled out were amazing. And now I think the big question that people have is, what kind of questions do I ask? How do I, everyone says that they've met someone and they can get their ear talked off, but unless you know the right questions to ask about their expertise or know how to verify, a track record, or if they're even willing to share financials of past projects they've done. How would you figure that out for people in your space?
So a few things that I would be super concerned about, whether you're buying or investing in a flip or you're investing in like a development project coming online. What is the as is value and what are you lending against, like your LTV? Like, you're buying $1 million piece of land and you're going to subdivide, it's going to be worth 3 million. Well, that $1 million piece of land, what is it worth today in case everything goes south? Like, hopefully it's worth 1.2 or 1.3 and you're buying, 80 cents on the dollar right up front. Secondarily, the comps, especially in development, are huge. So I want to see not just Zillow listings or land.com listings or even MLS sales. Like, I want actual verifiable comps. And that's what I provide to my investors. I go into the public records. I pull the comps of what's actually been recorded. Texas is a non-disclosure state. So I'm pulling deed of trusts and the financing, owner finance sales in a given county, in a given area, because those are verifiable and recorded at the county. So I'm providing that. I'm doing Facebook testing before I even buy the piece of land to make sure demand is coming in. I want to know that there's actually going to be demand for these lots and it's going to sell. I would surely want to know that if I'm an investor. And then I guess the last component is that operator, can they give you like a report or a presentation? I do PowerPoints for my guys, like of the regulations of what is going to be required to, hey, you want to make 5-acre lots or you want to make 10-acre lots. Okay. The regulations component to developing is so critical. Like, what is going to be required? Do we need a groundwater study? Do we need to do paved roads or dirt roads? Like, I would be immediately like, okay, walk me through the county and state regulations for land development in this area and make sure that we're on the same page and the operator actually knows what they're doing, because you would be extremely shocked to know how many developers in the land space never looked at the state regulation code. In Texas, it's local code 232. They've never scanned through a subdivision regulation document. They just think they're going to go out and buy 100 acres and make 25-acre lots. They've never even pulled up the regulations.
And I think it comes down to, can someone really answer in a lot of detail like you just did?
Yeah. Yeah, I mean, do they know like local code, this, that, or the other? Do they know the groundwater? Like, you could tell pretty easily, if they just think willy-nilly, they're going to just go out there and do a survey and be fine. I mean, it's highly unlikely.
Switching over to a little bit, I know that it's not your main cup of tea, but you have done an LP investment yourself. Do I have that right? I think it was in storage.
I did, yes.
Okay, so I'd love to, this show's targeting LPs, helping LPs become better, and I always think it's great to highlight that even some operators do their own LP investing, even if it was just to dip their toe in the water. Tell us what led you to doing it. Give us the deets.
Well, I had a tax bill back in, I think it was 2023. And, it was an investor friend of mine who I trusted. He said, hey, I got the storage property. Give me, it was only 100,000. Give me 100,000. You're going to have a tax benefit here. And we're going to provide you with a K1, et cetera, et cetera. Gave me a presentation of the property, of course. It seemed like a good project. And, back to our conversation we just had about operators, like this is an operator I trusted and, obviously knew his stuff. So I decided to give him $100,000.
I love it. And I guess from that experience, tell us, is there anything you feel like you've learned from that? Do you think you see yourself doing more of these moving forward? Or like, how do you'd primarily want to keep doing your own deals and you only kind of go out of the land space if you need to solve a different problem?
Exactly. And if I'm being completely honest and upfront, which I always will be, it's not something that's high on my to-do list to do again, just because the return in land is so high. I would honestly, it's funny. I learned because there was mistakes in the K1, there was this or that we had to walk through. And so like I got a good education in the process. And so talking to my CPA, we actually sat down and did a whole breakdown of like, okay, this is your savings on the capital. This is what the annual rate of return equates to be versus if you invested your own money and just paid tax on it, et cetera, et cetera. And at the end of the day, obviously it came down to the fact that my returns are so substantial in land. I would rather actually just pay the IRS and go do more deals with my money. Now, the caveat to that is like, okay, if you actually had a sweet property where you had a bunch of bonus depreciation and, you levered your money with either seller financing or a bank loan and, you had a $500,000 tax burden, you can give, 500 or million to the IRS, whatever it is, and have no tax burden. Like, yes, I would do that. But it's just, this deal wasn't a bad deal. It's just really, especially with the K1 being off the first year. And it's like, you don't really know what's going on. It wasn't I feel like not 100% transparency on the write-off there and the bonus depreciation. It's like, I would have to really consider doing it again and have a trusted operator. I would like to educate myself a little bit on either multifamily or storage and kind of just go do my own deal if I really had the time and energy to do it, obviously.
Yeah, I love it. I love the take. Yeah, I think that's actually pretty often the case where, you hear about all these benefits and I've seen many of them not come true.
I was going to ask your experience, like how many have not come true, or the K1s have just been completely off or disaster or whatever.
I've had K1s definitely come off, but I've had, there are definitely been investments, like I've invested in oil and gas, and nice. I know that I've written off 89% of my invested capital and through depreciation and within the first 3 years. And so those are definitely great vehicles and the cash is rolling in from that. It's fascinating because I think it's easy to let the tax tail wag the dog. I think similarly to you, I think there are other ways I would prefer to get depreciation or invest in my own deals. But I also like the diversification of being in things that are not like interest rate, dependent, especially in the economic times that we're in right now.
correct me if I'm wrong, but I feel like the cash flow component of these investments is super important. Like on the storage deal, I think I've only gotten dispersed $1,000 in, 2 years. So the cash flow is not there. I mean, so, you get these tax savings, but what about the cash flow?
Yeah, I think, hard to speak because I don't know the details of your deal, but I think if you invested any time in the last 3 years with, we had rising interest rates, we had
Sure.
insurance go up, we had property taxes go up, which is like the three killer, biggest line items on a property that happened, due to all the inflation. And so, yeah, I think there is something to be said about when you invest in the cycle, pay a big deal. But yeah, I mean, a lot of them don't cash flow. I really think if you are looking for cash flow, you have to find cash flow vehicles like the note investing you were talking about, or investing in these debt funds where these vehicles are designed to give you interest.
Yeah. Yeah. Cash flow is my middle name, man.
I love it.
Gotta have cash flow.
Yeah, it's gotta have cash flow. I love it. Okay, give us. This has been amazing today. Give us, where can people find more about you, learn about you, and follow along? You're big on Instagram.
Yeah. Yeah. I try to do most of my stuff on Instagram at John Jasniak. Same on YouTube, johnjasniak.com, John Jasniak on Facebook, John Jasniak everywhere. But Instagram is my favorite channel. Secondarily, YouTube. I got a big purchase that I actually just made today. And so there'll be a whole new series kind of coming, almost like a podcast series on YouTube, and a lot of cool content on that and Instagram and stuff. So I try to do the edutainment stuff, like keep it educating, but also do crazy stuff, like whether I'm throwing stuff or doing donuts or, crazy stuff, trying to be funny. Yeah.
They are pretty good. I immediately after I saw him online, I was like, I've got to talk to John. He's interesting. And if you're listening and you want access to deals like the one John puts out, plus a resource to help you evaluate operators with a little bit more confidence, I put together a free passive investing starter kit, and you get access to a bunch of free deals and education. And you can get that at passiveinvestingstarterkit.com. Also, come meet me in person at the Best Ever CRE Conference, February 18th to the 20th in 2026, Salt Lake City, Utah. I'll be leading an exclusive LP-focused workshop to help you evaluate deals with more confidence, ask smarter questions, and avoid the biggest mistake passive investors make. Tickets are normally $1,000, but right now you can grab them for $695, and I can guarantee you that these are the cheapest that they will be. And, with that, here on the Passive Income Playbook, part of the Best Ever CRE show, we drop episodes every Thursday. So be sure to tune in each week for more conversations like this one to help you become a better LP and passive investor. And as always, if you enjoyed today's episode, please subscribe, leave us a 5-star review, reach out to us on LinkedIn or Instagram in John's case, and say hi. It really helps us just get to know who's listening. So thank you for tuning in, and I will see you next week for another episode of the Passive Income Playbook.